Hi, I'm Alex, welcome to the channel and thanks for tuning in. Now firstly, sorry for the lack of uploads on this channel over the last couple of weeks. As always when this happens, it's down to my actual job. I've been pulling 120 hour, 130 hour working weeks, which basically leaves no time for anything at all. This coinciding with the market being spooked by inflation and the Fed's potential response, as well as the fears arising from the new Omicron variant, had many investors worried. Now, we have discussed on this channel for some time, for growth stocks, inflation fears and increasing interest rates will have a greater negative impact on the value of them, less than the impact than they will have on stocks where less of the value is generated in the future. This needs to be played carefully, either taking shorter-term positions and ascertaining where the market has overreacted and where there is some short-term opportunity, or alternatively, investing in robust, high-quality stocks which have a strong moat, growth trends underpinned by mission-critical demand, and which will deliver on their growth strategy over the coming years. The stock we're talking about today is a new one to the channel, but falls within both of these buckets. I believe presenting both some shorter term opportunities, but fundamentally what I believe to be a robust, long-term investment that for growth investors who understand the dynamics, can weather some of that volatility and non-linear growth in stock price for a period of time, is a good investment opportunity. The stock we're talking about today is DigitalOcean Holdings, trading under the ticker DOCN. In this video we'll cover everything that you need to know about DigitalOcean, what it does, some explanation of the recent drivers of stock price movements, the merits of this investment, and also the risks which we as investors need to be aware of. In addition to this, I'll also cover what I am doing in relation to this opportunity. Please smash the like button if you enjoy the video. We don't do clickbait on this channel, and it just means that the YouTube algorithm often doesn't share the video widely. By smashing the like button, it's massively helpful to the video and gives it the opportunity to be seen by a wider audience, and it's also massively appreciated. If you're new to the channel, make sure you're subscribed for more investing related content. And as always, whilst my full-time office-based job is investing, I'm not a financial advisor. This video is solely for information and entertainment purposes only, but let's get straight into it. So firstly, let's talk about what DigitalOcean is and what it does. So DigitalOcean is a cloud infrastructure provider focused on SMEs. In really simplistic terms, think of this as AWS, Amazon Web Services, or Azure for smaller sized businesses that don't have the technical expertise, capability, or desire to run and manage their own cloud infrastructure on the platform of the hyperscalers, and instead want a service wrapper around this, providing them with some support and assistance. A really important thing to say here is that it's clearly not that Amazon and Microsoft can't provide what DigitalOcean does. Clearly they can, but their focus is on larger enterprises and larger businesses. DigitalOcean provides a more simplistic and basic solution for SMEs, small and medium enterprises. It's also important at this point to talk a little about the historical stock price performance and what's happened here and why. So DigitalOcean IPO'd and first started trading on the stock market at the end of March 2021. It commenced trading around $41, and it wasn't until June when it started to increase its stock price slightly as more people became aware of the strong proposition the company had. It wasn't simply just trying to copy AWS and Azure, it does have its own strong reason to exist. Fast forward to the end of August. The stock price started trading slightly higher and was actually around $60. This is actually when it first came across my radar, when someone in the Patreon group first started mentioning it and discussing it, but unfortunately I didn't start doing any proper DD on it at this point. Fast forward to October is when I started spending a bit more time on it and realised the strength of the proposition it had, and it seemed at this same point in time many others realised this too, and it began rallying. Then you had the most recent financial results which were very strong and the market loved it. It rallied from here to just shy of $130. Now I'm super risk averse, I hate losing capital, and I just felt as though I was way too late to the party at this point. However, since then, we've seen the Fed increase its rhetoric around addressing inflation through higher interest rates, and the latest COVID variant has also sent some spooks around the market. This has resulted in DigitalOcean falling significantly to around the $75 mark, or where I was originally looking to establish a position in the company. This fall is not anything specific to do with the company, instead an impact of the broader market conditions, especially for growth stocks where valuations are impacted more significantly by increased interest rates. So look, this clearly comes with some health warnings which we will discuss later in the video, but also has an exciting proposition and concept for its customers. So what are the investment highlights? So the first highlight to talk about is DigitalOcean's impressive growth strategy. The company's delivered strong growth historically and is well positioned to deliver further continued strong growth over the forecast period, which is underpinned by compelling growth tailwinds. In its most recent Q3 filings published in early November, it reported 37% revenue growth and annual recurring revenues of $455 million, which are growing at around 36%. It also reported new customers growing by 7% to 598,000. As a side note here, it's great to see huge upsell for the existing clients driving revenue growth, as this shows the massive potential here that the company is starting to deliver on. Now, another important data point here is the net retention rate of 116%. That basically means that the growth in the existing customer revenues outweighs revenue from customers which are lost. For reference, a net retention rate of 115% is very good. Now, whilst these are great figures, what's more important is how sustainable this is and how it can continue to grow. The addressable market for DigitalOcean is massive and it's forecast to continue to grow. Digital transformation is not going anywhere, and any legacy sector which is not embracing tech enablement currently will be in the very near future if it is to survive. Currently, the addressable market for DigitalOcean is over 100 million customers, and this is growing by around 14 million new customers each year. At this point in time, DigitalOcean has around 600,000 customers, so clearly their share of the market currently is tiny, and this represents a great market opportunity for them to capture more market share in a rapidly growing market. The other important dynamic to keep in mind is that new companies which are being founded are typically digitally native. They're almost required to be in order to survive. So as a result, DigitalOcean is very well positioned to capture a large market share of the new businesses which are being created and are growing and scaling. Now, clearly the failure rate of companies is the highest for the group of customers which DigitalOcean targets. So DigitalOcean will have to battle potentially higher churn amongst its customers, as there's that greater likelihood of them going bust than the likes of AWS and Azure. Now, whilst we're on this point, it's also important to talk about the fact that as a result of much of the stimulus and job retention schemes introduced as part of the original COVID response, many companies which may ordinarily have gone bust and may have failed have been given a lifeline. Now, there is the chance that investors should be aware of that this results in a period of slightly higher churn as a result of this, and so investors should not panic if this does indeed materialise. Importantly, the growing average revenue per user, the ARPU, can be used as a strong indicator of the strength of the value proposition which DigitalOcean has for its customers. Now, this leads us very nicely on to the next point. This is a truly mission-critical offering for its customers. This is underpinned by the low churn, high net retention rates and the upsell to customers, demonstrating that once they've proven their value to customers, they're then able to sell them more products and services on top of this. DigitalOcean's customers are running their critical software, infrastructure, networks on their cloud platform, and this is 100% essential for the customer's business operations. It's not discretionary expenditure, it's not a nice to have, it's 100% essential. No compromises, no alternatives, it's mission critical. Now, the important consideration is why DigitalOcean here is winning share from very established competition, that being Amazon and Microsoft. Now, it ultimately comes down to its focus on smaller businesses and the service wrapper and proposition which it provides alongside this being more suited to smaller companies. Smaller companies struggle with the service provided by Amazon and Microsoft, and the service level and support is just inadequate. Managing a cloud infrastructure is complex, it's not easy, and for smaller companies with less sophisticated technology capabilities, the offering from DigitalOcean is just superior. Add this to the fact that DigitalOcean's proposition is slightly more cost effective for smaller businesses, and for the fact that for AWS and Azure to deliver growth, winning small customers like those which DigitalOcean is targeting barely moves the needle for them, and so it's not a core focus for them at all, and so this gives you a pretty interesting competitive position and an ability to continue growing and capturing that market share. The global footprint which DigitalOcean has too is significant for delivering its growth. Not only is its infrastructure global with 14 data centers across 8 different regions, it also has a global customer base with customers in over 185 countries. This is important because word of mouth is also significant within smaller business communities, so being a globally recognized go-to provider for this for smaller businesses is really important. Now, another really important investment highlight to address is the financial profile too. Growth has been consistent both within revenue and EBITDA margins have also grown, which again is demonstrative of delivering economies of scale. Often in tech stocks you can see the growth at the expense of those margins, but this is not the case here, so that's great to see, and it clearly demonstrates the strong control over the cost base which the company has. So whilst the merits of an investment into DigitalOcean are highly compelling, it's clearly not without risk. The recent volatility in stock price alone should demonstrate this, but it's important for any investors looking at this stock to keep that in mind. So, with that said, what are the main risks? Well, the first risk I see is around valuation. As we've touched on already, DigitalOcean is a growth stock. Its current valuation is justified by the significant growth potential the company has. Now, this is important, as failure to deliver on this growth, or a perceived shift in either the deliverability or value of this growth, will have an impact on the stock price. This is where inflation and the Fed's response to controlling this inflation comes in. Inflation is not a new topic on the agenda. However, the shift in the recent narrative from it being transient to something longer term is a new development and is currently spooking the markets a bit. The Fed's inevitable response to this is the increasing of interest rates, which will clearly have an impact on the valuation of growth stocks. And personally, I wouldn't be surprised if we did see a couple, maybe even 3 rate hikes next year. Now, this is a discussion for a completely separate video for those who are interested, but I'm not 100% on board with this inflationary story and this long-term inflationary trend. The current inflation is driven by supply side, not demand side dynamics, and ultimately controlling that inflation with demand side tools such as increasing interest rates just acts on the demand side of that, which is not driving the current inflation. Anyway, a topic for a completely separate video we'll go into in much more detail. However, anyway, back to the point. It does seem as though some of these interest rate increases have been priced into the market. Now, we're not going to go into the technical detail of why this is the case. We've covered it loads on this channel before, but higher interest rates are detrimental to the valuation of growth stocks. And as a result of this, we as investors need to be totally aware of this dynamic when establishing a position in DigitalOcean. Now, before we get back to the main point here being valuation, it's also important to add that increasing interest rates are bad news for the valuation of growth stocks. However, if the company does deliver on its growth strategy or can exceed the current estimates, then clearly there is room for stock price growth in the long term, which can outstrip the detrimental impacts from the increasing interest rates. Expect a bumpier ride and a less linear growth in your investment portfolio, but just be aware of it. Rather than blindly panic about this, conduct solid DD on your stocks, reassess your investment theses, and make sure you're ready for what is coming. Anyway, back to the original point and the risk here with DigitalOcean, its current valuation. At the time of filming, DigitalOcean is trading at around 20 times sales on a forward basis and 64 times EBITDA, again on a forward basis. These are punchy valuation multiples, and compared to other cloud computing peers, does sit at the upper end of that range. So clearly there is downside risk to the valuation here. However, personally I do think this is somewhat mitigated and offset by the market opportunity which DigitalOcean is addressing and by its growth potential. I think the important takeaway here is that there is clearly potentially upside to the valuation on a multiple basis here too. Recent stock price performance will indicate that. However, don't go into this thinking you're getting a bargain or an undervalued gem. Clearly, DigitalOcean does have a fairly full valuation. Now, onto the next risk, the potential loss of customers or an increased churn rate. There are 2 main facets to this risk, both of which are related to the fact that DigitalOcean has a focus on smaller and medium-sized businesses. The first part is based and predicated on the fact that many of these customers will grow and become larger businesses. As they grow, they will expand their IT infrastructure and internal capabilities, and there may come a point in time where those customers then could switch their cloud offerings from Azure or AWS. Now, there are a number of mitigants against this, which I see. Firstly, yes, while suddenly AWS or Azure could be considered, given that DigitalOcean have supported the company's growth to this point in time and that the pricing is favourable, the risk of switching probably outweighs the benefits for any of those customers of switching to one of the alternatives. If something works and there's little benefit from switching, but a high cost of something potentially going wrong, then there's limited likelihood of that switching, and that's important to keep in mind. Now, the next mitigant is that instances of multi-cloud solutions are increasingly common. This reduces the vendor risk for the customer, and again is perhaps a solution some of these customers may take as they grow larger. So rather than churning from DigitalOcean, instead decrease their spend slightly, whilst also taking offerings from AWS or Azure. Ultimately, given the period of time that the company's been listed on the stock market for, and the level of historical information disclosure we have, this is not something which a massive amount of analysis can be done on just yet. Clearly here, the other offsetting factor and mitigant is that new businesses which are founded act as potential new customers for DigitalOcean, significantly outweighing the potential lost customers from those growing too large on a volume basis. Yes, clearly the flaw to this is that larger companies will be paying more, but this is something we should try and get to the bottom of, should try and unpick as we can get more information from the company. Now, the second part to this is that clearly smaller companies are at greater risk of going bankrupt and failing. Now, we did touch on this earlier, but it's important to refresh our minds on this point. Smaller companies do fail more often than larger ones. That's a fact and it's not disputed, so investors should expect to see a slightly higher level of churn in DigitalOcean's customer base versus some of the cloud players that are focused on larger companies. However, there's also the additional risk here that some of the smaller companies that would otherwise have failed and got bankrupt have been kept artificially afloat and alive by the measures from governments in response to COVID-19. Certainly, the initial data showed that the bankruptcy rate, i.e. the percentage of companies going bankrupt each year, had decreased. Clearly, there's a normal annual baseline level. As this support is withdrawn, will we see a larger than usual bankruptcy rate that occurs as a catch-up as too many of the companies which would otherwise have failed have been given a lifeline? This is something which investors should keep in mind and be aware of. If this does happen, clearly any investors who are not prepared for this may be spooked, and so you can expect some volatility in the stock price around this period too. Now, I think the next risk which investors really do need to be aware of and consider in relation to DigitalOcean is the potential for a tech market correction. Now, clearly everyone has their own views on this, I certainly do, but this is something which should be factored into any investment decision when looking at something in the tech sector. A broader correction of valuation in the tech stocks will clearly impact the stock price for DigitalOcean. However, the way I look at this is that it will not occur readily and evenly across the whole tech sector. I think the mission critical infrastructure like tech plays, cloud infrastructure being a perfect example of this, will be the ones which prevail and fare the strongest in any correction. On the flip side, I think the single point solutions, ones which could be easily integrated into existing 365 offerings, for example, are the ones which are most likely to be impacted by the greatest amount. Now, I also think investors in tech in general should be acknowledging a far greater degree of volatility, especially around earnings windows, than they have been historically. Any differences against growth targets, positive or negative, churn rates, new customer wins, average revenue per user versus the estimates will likely drive greater volatility in the stock price than they have done historically, and so investors in stocks like this need to be completely cognizant and aware of that. So with that being said, what am I doing in relation to DigitalOcean? Well, the first thing which needs to be clarified is that you need to clearly understand the risk profile here before making any investment. As the valuation goes up, so does the execution risk, in the sense that the failure to deliver on the strategy is more costly for investors. The recent rally has demonstrated some of the potential here for the stock price growth. However, the recent fallback, albeit attributed to broader market wobbles, specifically related to COVID and Fed actions about inflation threats, demonstrates that there is still the strong possibility of further volatility in the stock price. When these dynamics are at play, effective and best practice portfolio management is essential. As such, I'm putting some real health warnings on this one. Initiate a position very carefully indeed, do it over a period of time, and do not deploy all of your capital at once. Also make sure that before you do initiate a position in the stock, you know what your exit strategy is. Are you playing this as a short-term opportunity or as a longer-term one? What are your price targets and how will you exit this? Investing without a knowledge of this is no better than gambling. So, in conclusion, I am establishing a position in DigitalOcean over the coming weeks with a long-term time horizon. I'm looking to see the company capture more market share and win new customers. I'm looking at this as, say, a 3 to 4 year position, but clearly I will continue revisiting the company's performance versus its strategy and the broader market dynamics. Anyway, that's it for today. Thank you so much for watching. I hope you enjoyed the video. If you did, please smash the like button, subscribe for more investing related content, and check out the Patreon group for private Discord and other stuff. As always, please let me know your thoughts and comments in the comments section below. I love hearing all the different opinions and perspectives, so please get involved. Thanks again for watching, and I'll see you in another video.